everyone, and welcome to the October edition of Ag Economic Dialogues. We are joined today by Oscar Miranda and Whoi Cho. They've got some great topics for us, so I'm not going to give too much information. Whoi is going to kick off the conversation, talks about some recommendations for pasture, rangeland, and forage, the rainfall index crop insurance components. So I am just going to turn the stage right over to you and let you share screen, and we will rock and roll from that vantage point.
Sounds perfect. I'm gonna share my screen for it. So now it's working everything, right?
Looks good.
Perfect. Okay, I'm gonna kick start off. Good morning, y'all. I'm Whoi Cho, Assistant Professor of Applied Economics at Nat School of Management and Economics at South Dakota State University. Today I'm gonna giving kind of recommendations for pasture rangeland and forage rainfall index crop insurance topics to you because these programs deadline is gonna upcoming. So December 1st is gonna be deadline for the enroll. So I highly encourage you all to enroll this program if you have in pasture land. So I'm gonna talk about what I found and what I'm gonna tell you in a guide recommend for it. So briefly go over about PRF-RI program. How many people are familiar to this program? When I asked to my class, most of them raised their hands. So I believe most of like ranchers and then producers at South Dakota State may be familiar to this topic. So PRF-RI program, pasture and range, pasture rangeland forage rainfall index program is established by the Risk Management Agency, RMA, in 2007 as a pilot program. So when they started, they gave them like two different options, like rainfall index and vegetation index to determine about their indemnity of their productions. But in 2014, this program is only focused on rainfall index. So they just only care about like how many rainfalls, I mean, how much rainfall came in 2 months. And then if they're below their average level, they could payouts going to be happen. So this program is expanded to 48 contiguous states in 2016, and then in last year, this year's 2025, they also available in Hawaii as well. In South Dakota, this program is eligible to enroll, available since the 2011, but that time was for 2 years, just only available for the vegetation index, VI. But in 2013, they started to offer a rainfall index only for South Dakota. So technically, PRF-RI program is started and available from 2013 to so far in South Dakota. This slide is I'm really thank you to like Dr. Dearson who attended right now. He made up this table for these presentations. This one is a 2022 Census of Agriculture and the Pasture Land of United States and South Dakota. So South Dakota's pasture land is a 5% of total pasture in the United States. So pretty this program is really important to um this South Dakota. So I'm really happy to see these numbers. And then I thought like, oh, these topics are gonna be really useful to South Dakota people. So in South Dakota, PRF-RI, their participation is keeping increasing as shown on the bar chart. But in the COVID era, they're shrinking down, so they have a really bump, but keeping increasing trend. So as shown on a previous slide, their total pasture land is a 23 million acres by USDA census. So compared to that, how much acreages enrolled actually, and then calculated the percentage with this bold line. So percentage of total forage land enrolled. in this PRF-RI program. So in 2025, 35% of total forage enrolled, and then they have keeping having an increasing trend. But I just want to point it out, these numbers may be overestimating because these PRF-RI programs having a different offer them different options when they select their coverage, and then their reported systems reported e each timeline having a one like acres. So I mean, like I'm gonna explain more about their interval things. So one interval, so they have an 11 interval total, but if they pick them like many intervals at the same time, that 1 acre is just gonna be counted twice over than like twice. So these numbers are gonna be like at least doubling, or depending on their selections, like one half or quarters is going to be actual adoption rate in the South Dakota. So when I calculate them just briefly, just half is a 18%. So 18% of acreage is only enrolled in this program and insured by this program. So I was like, still South Dakota producers have to enroll this program. That's why I'm talking right now. But we are thinking about why people do not like their adoption rate is not like super high up. So after started this program, like introduced the programs already 10 years passed. So I guess most of them's already heard about it. So their recognition or is it gonna be enough? But they have really complicated coverage options. That's gonna be one reasons to people do not enroll this program, I guess. So I just want to briefly go over about their coverage selections they offered. So they offered 3 different categories to producers choose when they enroll this program. First, coverage level, productivity factor, and then bi-monthly interval indices. So coverage level is just a threshold value to calculate their indemnities. So historical values converted to their index. So 100 is going to be their average. So their rainfall is actual rainfall is less than their historical average values. Their rainfall index value is going to be below the 100. So when they're setting the coverage level, and then the threshold values difference is going to be calculating to their indemnity amount. So that they have 5 different values offered, 70 to 90% in 5% increments. So when I see their statistics from RMA, over 80% of insured acreages at 90% of coverage level in South Dakota. So most producers just want to get a more coverage level, more higher threshold values to pay out for it. And the productivity factor is a 60% to 150% with a 1% increments. So they can choose like 91 different values. This one is also kind of adjusting factor to calculate about their productivity on their own pasture land. So their indemnity is calculated by their county-based values offered from RMA. That's the value from the 1 acre of their pastures, depending on their counties. However, sometimes my land is gonna be way lower than that values. We can pick on like 60% for the productivity factors to adjust and insure my field. Or my field is having a really great productivity. We can pick on like 150 and then getting payouts more. A last option is a bi-monthly interval indices. They offered 11 bi-monthly intervals like January, February, March, April to November, December. They have to peak, and then they have to give them different rates, and then making their final coverage selections for PRF-RI program. They have several rules, so they need to assign weights non-overlapping bi-monthly intervals. So they want to ensure like June, because June is the most production month for the pasture. They cannot choose May, June interval and then June, July interval. They had to pick May, June or June, July, either one. So not overlap the same month. Also, they could give like weight from each intervals at least 10% for the minimum if they pick that interval, and then that all weights has to be sum 100%. And the maximum weights are different by state, but South Dakota's maximum weight is 70%. So think about how many possibility, how many coverage selections we can choose. Like briefly think about 100% and then 11 intervals and then giving us 170% and then finding three different intervals. Just calculate them. I can't calculate that. Really endless values and then endless possibilities came out from their coverage selections of options, right? So too many choices options producers had to face when they decide to enroll this program. So previous literatures warned about if they have too many choices, maybe choice takers is gonna be filled decision fatigue that can be lead to avoid their choice. So in this program, do not enroll this program or just follow the default options. So just follow their given options or agent saying like this way is gonna be most like common way, they're gonna follow them. Also, decision fatigue can make them to lose their focus and then they cannot do like analytical approaches. So this program is an insurance program, but they just want to see like how I can get more money, get out from this program. Like do not related to this insurance. I mean, insure my forage land. So if that is like continue for that perspective. So most people may think and treat this program as a lottery. So just guessing about which month next year, which month is going to be more drier than this year's kind of it. So if you follow that, they're going to choose non-growing season intervals like January, February, or November, December, even if they have a high premiums, they have high payouts, possibilities out there. So I just put on their fun figures with the slot machine things. So small money and then insure their things, or more money and then just getting for income. So people's gonna thinking like how much like probabilities available when they pick this, how much probabilities to pay out making when I pick these options or that options. They compare for that. So that's not ideal. That's not aligned to original intention for this program. So I just want to see and then guide them how to use and then which way is going to be good. But for that, actual um, we want to see how their actual choices are going to be changed over time. So I've collected the data from 2016 to 2023 in the United States, and then see their total insured acreage percentage differences. So just going with the 2016, January, February, March, April, May, June, July, August is a 9, 10, 13, 13, 10. So that looks like evenly distributed or giving them more weighted to May, June, or July, August. When they started, people's maybe like just follow what these programs wanted to for. But over time, in 2023, January, February, March, April, 17, 13, 17%. And then October, November, December is over 10%. And then growing seasons, like less than 7%, like 5 to 7% picked by producers. So producers change, like their choices moved over to non-growing seasons and treated this program as the income sources, like previous slide showing on slot machine, they just put in more money and then giving them more payout probabilities. So we just thinking like that choices are gonna be wrong and then see how actually payout made. So we've made a loss ratio figure. So loss ratio is how much ratios, the ratio of how much payouts happen compared to total premiums collected to this program. So easily how much producers are getting paid and how much they paid compared to that. So average loss ratio is 0.89. That's aligned to US crop insurance targeted too. So 0.88, that's what they designed it for. So average loss ratios looks good, but as shown on the figure, they're really skewed to left side and the right side. They have a little bit big dump on the middle of the April to September, October. That means so for also like January, February, and then February, March, their loss ratio is a really high, looking like it. So total indemnity is greater than total premiums. So that means producers get paid more than they paid. Also, insurance company perspective, they spend more money than they got the money from producers. So long term, really, it's a little bit worrying about their sustainable this program if the people's gonna keep choosing these months for getting a more payout things. So it's kind of like possibility to have a problem on a mispricing or just small sample things. But so far we got these problems. And then when loss ratio is a 2.4, so I just calculated actual effective loss ratio that's calculated for expected indemnity per $1 premium paid by producers. So 90% of coverage level when they selected, government's gonna subsidize 51% of their premiums. So for January, February cases, their actual loss ratio is 2.45. That means they paid $1 premium and then paid out $2.45, and then February, March is at 3.12. That loss ratios happen. So producers, their changes was right, but I was wondering about is it real right? So my research work was focused on like how South Dakota producers have to choose their PRF-RI coverage selections depending on the strategy. I'm not going to explain about their mathematical notations, so I just put all the data and then approach informations on this slide. We use PRF-RI program informations about county-based value to calculate their indemnity and the premium rates by each interval, and then we used 30 years rainfall index values from RMA's their website. And then basic revenue information. So we are compared to producers, if not enroll this program, how much they averagely make from their forage land per acre. So for that, we use the yield and hay prices, but NAS is a no longer reports their hay estimate, so we use forage yield as a proxy estimate. So we use hay price and the forage yield for calculating their basic revenue, and then these PRF-RI programs, how much they're making reduce their risk. I mean, how much they make them, how much they help to get them stable income for the producers, or just getting more money for maximum profit approaches. We compare two different strategies with the mean variance approaches compared for it. In South Dakota's 6 county-based values are offered from RMA depending on their regions. So we picked just 8 counties, just pick from ourselves, just pick randomly, for example, for this program. So this figure is a 2023 RMA 6 county-based values map. Which county is having which county-based values I made for it, and then we use these oranges 8 counties for examples. These results for maximize profit things. So their results shown on the table that percentage is gonna be like weights for getting their expected returns. And then in the parentheses, we put on like their variances, how much they're variable for their incomes. So as shown on table, ideal profit max strategies peaked on February, March, or November, December, except for Yankton. So mostly weighted into like one intervals, and then others seconds high probability of high expected payout intervals are going to be like 30%. That's a February, March, and November, December's. So it feels like non-growing seasons mostly peaked in for profit max. Um, so on average, expected profit is a $16 to $75 per acres higher than non-contract cases. Definitely these programs are going to be held to increase their revenue. But as shown on the red circles, not circles, red squares, red places, their variance is going to be higher than a non-contract cases. That means like if they peak like non-growing seasons intervals, they could have more changeable, so they cannot guarantee a stable income with their high amount of expected return. So their risk is going to be increasing if they peak their non-growing season intervals. For minimizing risk, they're looking like more allocated, even not evenly, but allocated to like more months to secure their chances, and giving them more weights to March, April, May, June, July, August, or production months is given more weight for it. So compared to their expected income, risk minimization strategies, getting a more profit, $10 to $30 per acres than non-contract cases. So still, even we are contract like enrolling this program with the risk minimization strategy, they can make them expected more profit they can make. So this year's I just get them NRCS, they're on a forage map about their productions. In June 1st, they're having some regions look good, but some regions are not. And then on September 1st, 2025, their productivity outlook looks greener. So their forage productions looks like great this year's for most part. So these programs possible, so PRF-RI programs possible to give non-indemnities this year. So people may think these programs are not going to be worth it to enroll it because their payouts not going to make it this year's. But how we next year is going to be like drier than this year, so our forage productions are going to be not good for next year's. We don't know it, so this program is still worth it. So from my presentation's takeaway is enroll this PRF-RI program, and deadline is December 1st, 2025. This program is definitely worth it to ensure your production risk from the lack of protect your production risk from their lack of precipitation. So highly encourage you all to enroll this PRF-RI program. And then I'm gonna suggest them two different ways for coverage selections. So just pick them like 90% and then 100%, 90%, and then adjust the productivity factors depending on your field, and then pick them by monthly intervals for growing seasons if you want to keep your steady revenue against dry years. So March through September, so you're gonna pick them that month and then giving them more weight, and then trying to pick them more intervals as much as you can. But if you are taking a risk and then still want to getting a higher profit, just select the low rainfall months like January, February, and February, March, and November, December, and then giving them like just let more weights to like both of it. They're gonna be giving a more higher profit, but we don't know about they're gonna be work well. So, but these insurance programs are gonna give in a more expected income without this program. So this program is really worth it. So I really want to hear about your actual practical opinions about this program as well. So any questions so far?
Thanks. Does anyone have questions for we regarding PRF and the different categories and options that are available? Deadline again to sign up, we was December
December
1.
1st. Yeah,
Okay.
December 1st.
All right. So if you're interested in that, crop insurance agents sell this product, and that would be, who to work with, correct? You go to your
Right,
local crop insurance agent.
right.
Okay. I don't see any questions in the chat or from anybody unmuting their microphones right now, so if you can hang around, that would be great, and we can maybe get some questions at the end. Otherwise, all of Wee's information is there for you if you wanted to get a hold of him directly.
Right,
So with
definitely.
that, thanks again, and we will rotate to Oscar and his presentation today.
So my turn.
There you go. So Oscar's going to join us today. He's taken a look at how farmer cooperatives are changing in the Midwest. So some of those projects that he's looked at that direction. So I'm not going to steal his thunder and tell you all about it. I'm going to let him share his slides there, and we will go from there.
Thank you, Heather. So, can you see my screen?
Yep, looks great. Thanks.
Okay, so hello everyone. My name is Oscar Sarasota Miranda. I'm an assistant professor at the Ness School of Management of Economics. Um, what I pick cooperatives, there is a reason more than cooperatives are an important kind of business, especially for the region. And because cooperatives are member-owned kind of business, that the objective of this is to get benefits for the member more than those profits like in a regular for-profit kind of business. So these benefits can come in a lot of forms. So it can be a greater price for the members when they are selling their crops through the cooperative, but at the same time, they can be a discount price on the inputs they are using, or they can be an access to services that if it was not because of the cooperative, the members were not going to be able to get. So with that, I also want to start like October is the world and the national cooperative month. And so here in October, we try to remember why cooperatives are important. So every year in October, we are going to have a theme about cooperatives. So for example, last year's theme was that future is cooperatives. And that theme was selected in order to highlight the role that cooperatives have in production, because how they create a more equitable and sustainable business model for the members. This year, the theme is going to be cooperatives build a better world. And the objective of this theme is to spotlight how the cooperative model is an essential solution to overcome a lot of those challenges that producers in the areas might have. So with that, I want to start with this. So the cooperatives in the Midwest are very important and are an extremely important part of the Midwest crop economy. So and that goes as well with a fact is that almost half of the United States cooperatives are located in the Midwest. And I want to complement that with this map. So in this map, we can see the main crops and the main commodities for each one of the states in the United States. And as we can see, the Midwest is an area that is dedicated to grains and oilseed production, mostly corn, soybeans, and wheat. So this gives us the question on why cooperatives are going to be important for this area. And that's going to be because farmers in this region, they are going to have similar production cycles, they are going to face similar risks, they are going to have similar infrastructure needs that makes the cooperatives to have the better, good environment and a good condition to operate, because they are going to satisfy a lot of those members' needs, not only for marketing their commodities, but at the same time providing those services and those supplies that they need for their cycles. So for example, and this is one of the examples I use in class, cooperatives are important, especially if you are a small scale farmer or a medium-sized farmer that produce corn. So for a small farmer or a medium-sized farmer, having a grain elevator just for that operation, it might not make economic sense. But if we have a grain elevator for a lot of producers in the area that have a very similar product, this is going to allow them to aggregate in volume. That is going to reduce their transactional cost, and as well, that's going to give them market power against the large agribusiness that are going to buy their commodities. So they are going to have a better position at the time they want to commercialize. So with that, I want to show you how the cooperatives have shifted in the Midwest in the last decade. So over what we can see over the last 10 years, so from 2014 until 2023, we can see a decline in both supply cooperatives and marketing cooperatives. One of the things we need to see from this, the blue line represents the marketing cooperatives, while the red line represents the supply cooperatives, is that we are going to see that the supply is a more stable, but the marketing that presents a steeper decrease in the number of local cooperatives. So that not necessarily means that cooperatives are disappearing. In fact, what this means is that these marketing cooperatives are merging to create bigger cooperatives that are more regional and operating more than one state. And this is going to be helpful for the members because this merge is going to create economies of scale for their operations. And also with that, we're going to see a reduction in the total transactional cost, the marginal cost, but it's going to be reflected that we are losing the number of cooperatives. And to complement with that, I want to show you this. So here we have the crop cash sales. So how in crops, how much are selling in $1 billion, and how much of that is going to be sold through the cooperatives. And as we can see, that number hasn't gone down. We can see a very stable number, and we can see very similar trends. So when we see this crop selling more, we can see as well commodity cooperatives selling more, and vice versa. If there's a smaller sales of commodities overall, we can see a decrease in the cooperative. So we can see that we are going to have more stable numbers. And so the main takeaway from this is that we can see that cooperatives move as the market moves. And this can be reflected as well in the case of South Dakota. In South Dakota, we can see marketing cooperatives, for example, marketing cooperatives as well have going down, meaning that we are going to have a little more of consolidation following the Midwest trends. At the same time, we're going to see that supply co-ops are mostly flat, meaning that they are remaining in the market and we don't have a decrease of those supply and service cooperatives. So that going back, that means that the cooperatives in South Dakota, especially those marketing cooperatives, are merging into those bigger cooperatives that are operating in the region. That is going to be beneficial as well for the members. And in the graph in the right, we can see how South Dakota sales of commodities are associated with the sales of grains through the cooperatives. And that's the similar trend as we saw in the Midwest. As if we sell less commodities in the overall market, cooperatives are going to sell less. And if we sell more, we are going to sell more through the cooperative system. But with this, we are going to have some questions that arise. So what's happening in the cooperative system, and especially those marketing cooperatives that are not disappearing, but instead they are merging and they are in a new phase of that structural adaptation that is pushing them for consolidation. So this is happening because we're going to face that market competition and that an extra need for infrastructure cost. That infrastructure has increased in price. So cooperatives, in order to keep that pace, they are consolidating so they can have more capital to follow the responses of the market. So this consolidation also creates an efficiency in the case of logistics because we have bigger infrastructure that can serve more members, as well transportation. More than that as well, we can get that bargaining power that comes from working together as a group. And we can access different markets, so we are going to have a greater market access. This is not only good as well, we're going to have some challenges, especially this is going to come from the governance of cooperatives, because large cooperatives mean that they are going to have more members. At the same time, they are going to be more spread across the map. And that means that at the moment that they need to take decisions, those decisions can take longer. At the same time, one of those principles of cooperatives that we like is that cooperatives have one member, one vote. So if we have more members, we can create that illusion that the members' importance in that cooperative is diluting. So cooperatives need to maintain competitive, and that's one of the reasons of those consolidations. But at the same time, we need to think about that member importance within the cooperative. So with that, in this research, we have these questions that we want to answer. So the first one is how cooperatives have changed their shares since 2014. What are the changes that we can see in the market? What patterns of consolidation and scale are visible for cooperatives, especially for grains and the business that they are doing in the market? And what are the strategic and managerial implications that this consolidation and this change in the market imply? So for that, first, we're going to look at how cooperatives market shares have changed over the past decade in the Midwest. Second, we're going to examine the structural trends to get insights into how they are adapting to market competition and how they are facing that infrastructural cost. And finally, we consider what these patterns are going to imply for managerial decisions and for the agribusiness. So consolidation may improve efficiency, may improve prices, may improve market access, but it also tests how cooperatives are going to sustain their member orientation and government rather than converting into a for-profit business. So the data that we're using in this project comes from the 12 Midwest states. So we're going to have data from North Dakota, South Dakota, Nebraska, etc. And what we get from this is going to be the grains and oilseeds sales by cooperatives, the overall sales of crops by the area, the overall cooperative commodity sales. So here in commodities, we're going to include all the different commodities, not only grains, but as well milk, and the overall commodity cash received from the area. We're getting this data from the USDA Agricultural Cooperative Statistics and the USDA ERS Farm Income and Wealth data. So to give you an idea of what is a share for this project, basically, when we talk, for example, grain shares, it's going to be the grains and oilseed cooperative sales divided by the overall sales of crops in the area. So that is going to give us the representation that cooperatives are going to have in that market. So what we can find from 2014 to 2014 is that the grain share is going to represent the proportion of the crop sales that are handled by the cooperative, and the business share is overall what are the business that cooperatives had in the area. So the main results here that are presented in the table is that states like Iowa, Minnesota, North Dakota, and Kansas and Nebraska, for example, they depend a lot of cooperatives. So here, in this state, the typical cooperative activities are going to involve grain marketing and storage of those grains. So that is going to make those local cooperatives relevant in terms of logistics, in terms of distance. And at the same time, this is going to make those local cooperatives bulk the commodities and benefit the members for the prices they are going to be able to access through the cooperative system and that scale that they are gaining. The other share of those grains is mostly going to be commercialized by those private entities. We can see here ADM and Cargill, for example, and as well how the participation that they have in the market is going to affect the grain share that cooperatives are going to have. It's something that I like from this graph is, for example, we can see that the grain share for Michigan is 5.4. So that means that states like Michigan or Wisconsin, they sell just a little of the crops or their grains and oilseeds through the cooperative system. Instead, they sell directly to those private entities or other type of producers, especially because in these areas we have dairy. So dairy is going to be a more important and relevant cooperative business in the area. So that is reflected in the business share. For example, Michigan, we go from 5% representation of cooperatives in the market for grains to 51 representation in the overall business for agricultural commodities. And that's a reflection on how much the people in that area rely more on those dairy cooperatives for their business. So with this graph, what I wanted to show is how this dispersion has changed over the past decade. That's the reason we have 2014 and 2023. For example, in 2014, we can see a big dispersion on how much the states were doing business with the cooperatives. Some of the states were doing almost 100% of their sales through the cooperatives, where we find some states as well that they were doing non-business with the cooperatives. And this is going to change with 2020 in 2023. In 2023, we can see that a smaller dispersion. So that means that this consolidation and this aggregation that we can see happening in the cooperative system, especially for that merging of local cooperatives into regional cooperatives, is smoothing the cooperative share. So now we can see more stable numbers across the states. So most of the states are going to have among the same number of business with cooperatives, but we can see as well that the median share hasn't changed between 2014 and 2023, implying that cooperatives are more structured now, and they have a bigger line of business at the same time. And I like the example for that of South Dakota. South Dakota, here we have with the blue line, we're going to have the Midwest average of business done with cooperatives. And with the red line, we're going to see how South Dakota has behaved in the last decade. And so at the beginning of the 2014, about 70% of the business in South Dakota, especially the sale of grains, was done through the cooperative system. But this number has fallen a lot. And not only 30% of the sales are handled by those local cooperatives, meaning that now we have more stable numbers, and this aligns more what is happening in the overall market, because now these local cooperatives don't handle as much grain. Now the regional cooperatives are the ones that represent most of those changes. And as well with this graph, what I want to show is how sales have evolved across the Midwest. So here we can see very straight trends, like for example, Iowa and Illinois alone account for most of the regional growth for the change of the cooperative grain sales, while Minnesota, North Dakota, and South Dakota saw declines mostly because of this consolidation of those local cooperatives converting into large regional cooperatives. At the same time, we can see here that the effect of all those other players, especially the private entities or the ethanol markets, and the relevance that they have at the moment that producers decide where to sell and who's offering the better price. So this is going to suggest that cooperatives' grain economy is becoming more competitive, especially in the central part of the Corn Belt, given that in that part also they are going to have a competitive advantage in terms of logistics, technology, and exports that are pushing for more consolidation in the extended areas, reducing the competition as well from the cooperatives outside of those states. But in the other hand, states like Minnesota and the Dakotas, they saw the reduction in the cooperative sales due to this consolidation that are turning the local cooperatives into regional cooperatives, is reducing those local sales, and also the effects that we have in the distribution channels and the demand from the private entities and the ethanol producers in the area. So cooperatives keep the pace with the Midwest crop markets. So how they are behaving across the time. So as I like this graph because in the y-axis we can see the cooperatives grain sales growth annualized, and in the x-axis we can see the crop received sales annualized. So here most of the states are near or just above the line in the middle that shows that cooperatives are keeping the pace with the crop market, meaning that they grow as the market grows. So cooperatives are adapting better in those areas, maintaining a more stable role, or also meaning that they are expanding their operations, like is mostly the case of Michigan and Wisconsin. But contrary, we can see in South Dakota, Minnesota, and North Dakota that this participation falls slightly below that line, indicating that there's a decrease in the participation shares, especially for those local cooperatives, But again, this is not because they are disappearing. This is because they are consolidating into those regional cooperatives that are represented somewhere else. Something important I want to show as well from this graph is that all the states are in the right-hand side of the crop recipients growth. So that means that through the time, even when we don't see a bigger increase in the cooperative activity, we can see that the states are producing more, and so they are going to receive more benefits from the market operations. So finally, I have this graph, and we can observe here the relationship between crop market growth and the cooperative share of business. So this is the result for a fixed effect regression, and these results tell us that the cooperatives aren't losing sales. Instead, what is really happening is they are losing their relative position that they have in the market, especially from those local cooperatives that are turning into regional cooperatives. So in other words, every time that the market expands, one of the things that is happening is that those private entities are taking more of, or they are capturing more share of the sales of those crops, especially for grains and oilseeds, while the cooperatives don't grow as fast. So this is telling us that cooperatives are not disappearing or they are not decreasing their participation in the market, but they are just growing more slowly, meaning that the shares in the total sales decline with the bigger expansion. So in other words, if we can see a pie, if the pie gets bigger, the share of cooperatives or the slice of cooperatives doesn't get as big with the pie, meaning that cooperatives keep their business, but with the expansion, instead of getting more business, the private entities are capturing that business. So cooperatives are, this is going to be a challenge to capture this extra part of the pie, especially because of how cooperatives operate. So we compare cooperatives with the private entities. Private entities are going to have a relative advantage because these private entities can scale faster as they can move capital faster than the cooperatives. They can build storage facilities or they can access supply faster than the cooperatives, and they can respond to the price changes faster than cooperatives, offering better prices. And this is because of how cooperatives operate. Cooperatives are going to face member constraints because of that one member, one vote. So in order to take those decisions, they can take longer because they need to manage those local governance decisions. They need to finance through equity. And as well, service. We have those service commitments from the cooperative to the members because we need to maintain the benefits going to the members because we're following the cooperative type of business. So in other words, when the market booms, cooperatives lose ground against the private entity. So we're going to have some strategic implications from all this. First, we're going to know that consolidation is structural, not temporary. So the decline in the cooperative market share reflects the long-term structural change, not just a short-term cycle. So we can see here the growth of the private entities, the growth on the demand from ethanol producers. So cooperatives need to find a way to grow as much as those competition is growing in order to stay connected in the market, but at the same time, to be connected with their members and the communities that depends on the cooperative. Efficiency and scale are going to bring risk. It's good to have that merging into regional cooperatives because they can have more access to markets or they can have economies of scale, but we are taking the risk of what is happening with the cooperative system. So cooperatives are going to benefit from this, but at the same time, this is going to affect those small operations, and only large cooperatives are going to be able to keep the track and keep the competition with the private entities. Innovation is going to be an essential part of this, and this can come from the digital marketing tools. We can have some improvements in the supply chain. We can develop more sustainable programs, and this is going to strengthen the cooperative participation and relevance in the market, while at the same time, this is going to engage members more with the cooperatives and make more sales through the cooperative system. And finally, collaboration over competition. So alliances between cooperatives are essential, especially for those local cooperatives, because they can maintain that bargaining power, they can improve their logistics, and more important, they can share the risk of the market. So my conclusions here are that cooperatives are still a very important part of the Midwest, especially for the green economy, but they are not growing as fast as the competition. And that's the main problem. And that's the main thing we need to look for a solution. So this doesn't mean specifically that cooperatives are failing doing business. It mostly means that there are fast challenges and cooperatives need to keep the pace with those challenges and those changes in the market. So the future of cooperatives is going to depend less on the size, so less on if there are local cooperatives. They are going to depend more on how they do cooperations with other local cooperatives, or even though they merge and become regional cooperatives. And as well, this is going to depend a lot on how they are going to innovate with those merging or that collaboration, especially because the agricultural system is becoming more and more complex. So cooperatives remain a central part of the Midwest grain economy, but their role is shifting with the time, especially for marketing cooperatives that are consolidating into regional cooperatives. Market expands, favor skills and specialization, pressuring cooperatives to adapt and consolidate. Resilience depends on innovation and leadership, suggesting that the next phase of the cooperative success is going to depend on technology adoption, market adaptation, and more important, in the new generation of members. With that, that's the end of my presentation. Thank you very much.
Well, thank you, Oscar. We greatly appreciate the information that you provided there for us today. I didn't recognize or realize there was so much shift in what was going on across our cooperatives across the state. Any questions that you would like to ask? And we will just make sure that everybody knows we will be doing the dialogues again in November, so make sure you get registered for that, and we will see y'all next time for that one. So